It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored.
So this is a super interesting market, and there are a lot of people on edge, not really knowing what to expect or what to do because we are in uncharted territory. In a normal real estate market, there are benchmarks and metrics that we can judge to say, okay, if this happens, then this. But the thing is we're in an area of uncharted territory. We do not know what is happening. If someone says, for sure this is going to happen, they have no idea. But there are trends and there are things that we can do to prepare, especially if you're looking to sell or buy. And those things are getting educated in the market and knowing what's going on. So what I'm going to share with you today is a deeper dive in what's going on across the whole country and where interest rates are, what home prices are doing, the supply and the demand, and why it's so important to understand supply and demand and what the Fed is doing and other things to make it more difficult to get loans. During the 4 weeks ending on July 30th, the average monthly mortgage payment for the U.S. home buyer was $2,605. This represents a 19% rise from the previous year, but only a slight decrease of $32 from the peak in early July. The persistent high cost of housing is due to the elevated mortgage rates, with the current weekly average at 6.9%. Coupled with increasing home prices year over year, the median home sales price has surged by 3.2%, marking the largest jump since the past November. The surge in home prices can be attributed to the imbalance between supply and demand. Due to the high mortgage rates, many potential sellers have been deterred from listing, preferring to retain their current lower interest rate. This has led to a 19% reduction in total homes available for sale, the most significant decline in 18 months, and a 21% drop in new listings. While these high rates have discouraged some prospective home buyers, they have had a more profound effect on potential sellers. According to Redfin's Home Buyer Demand Index, which gauges early buyer interest through requests of tours and other services, there's been a mere 4% dip from the same period last year. Key indicators of home buying trends as of the week ending of August 3rd, the average rate for a 30-year fixed mortgage stood at 6.9%. This is a slight increase from the previous week, but marginally below the half-year peak reached 3 weeks prior, which had a daily average of 7.2% on August 3rd. For the week concluding July 28th, there was a 3% weekly drop when adjusted for seasonal factors in mortgage purchase applications. Yearly comparisons indicate a decline of 26%. According to Redfin, which assesses the demand of home tours and other related services offered by agents, they saw a 4% reduction both monthly and annually. Searches for homes for sale during the week ending on July 29th remained relatively steady compared to the previous month, but experienced a decrease of approximately 16% year over year. According to ShowingTime, a company specializing in home tour technology, touring activity reported on July 28th showed an 8% increase since the beginning of the year. In contrast, there was a 5% decline during the same period of the previous year. Redfin reported on the data collected from 50 of the biggest cities in the U.S., and here's what their findings revealed. The median home sales price was $380,250, up 3.2% from a year earlier. That's the biggest increase since November. Sales prices have increased most in Miami at 12.7%, Cincinnati at 9%, Milwaukee at 8.6%, and Anaheim, California at 8.5%, and West Palm Beach, Florida at 8.4%. Home sale prices declined in 19 metros, with the biggest drops in Austin, Texas at negative 9.9%, Phoenix at negative 4.2%, Detroit at negative 3.9%, Las Vegas at negative 3.5%, and Fort Worth, Texas at negative 3.2%. The median asking price of a newly listed home was $387,223, up 1.7% from a year earlier. The monthly mortgage payment on a median asking price home was $2,605, and at a 6.9% interest rate, the average for the week ending August 3rd. That's down about 1% or $32 from record high that hit 3 weeks earlier, but up 19% from a year earlier. Pending home sales were down 14.4% year over year, continuing a year-plus streak of double-digit declines. Pending home sales fell in all but 2 of the cities Redfin analyzed. They declined the most in Providence, Rhode Island at negative 29.5%, Newark, New Jersey at negative 28.8%, Warren, Michigan at 26.4%, Boston at negative 26.3%, and Cincinnati at negative 25.1%. They increased 3.5% in Las Vegas and were flat in Austin. New listings of homes for sale fell 21.3% year over year. That's a substantial decline, but the smallest in 3 months. The new listings declined in all metro areas. They fell the most in Las Vegas at negative 43.4%, Phoenix at negative 39.7%, Providence, Rhode Island at negative 32%, Sacramento, California at negative 31.9%, and Oakland, California at negative 30.7%. Active listings. The number of homes listed for sale at any point during the period has dropped 19% from a year earlier. That's the biggest drop since February of 2022. Active listings were down slightly from a month earlier. Typically, they post month-over-month increases at this time of year. Months of supply, a measure of the balance between the supply and the demand calculated by the number of months it would take for the current inventory to sell at the current sales pace, was 2.9 months. That's the highest level since April. 4 to 5 months is considered balanced, with a lower number indicating a seller's market condition. 43.7% of homes that went under contract had accepted offers within the first 2 weeks on the market, up from 42% a year earlier. Homes that sold were on the market for a median of 27 days. That's up from 23 days a year earlier. 35.9% of the homes sold above their final list price. On average, 5.8% of the homes for sale each week had a price drop, down from 6.3% a year earlier. The average list to sell price ratio, which measures how close homes are selling to their final asking price, was 100%. That's down from 100.7% a year earlier. The real estate market is continually shifting, but an air of uncertainty prevails due to various factors. Although houses are still being sold, sellers remain less motivated, primarily due to the attractive interest rate that they've locked in. Robert Refkin believes this trend will endure.
Their buyers have accepted 7% mortgage rates as the new normal, but sellers haven't. When you have 30% of homeowners locked in at 3% or below, you have 70% of homeowners locked in at 4% or below, they consider that a financial asset and don't want to lose it. So the delta between 4 and 7 is just too much for too many people. The current view is once it gets around 5, 5.5, we'll see a significant unlock of inventory.
Okay, I just want to interrupt this video to update you with a couple things. Number one, I want to talk about supply and demand and why it's so important to understand that when the supply is low, prices are going to go up. So if you notice in California, we have a year over year of our sales inventory growth at negative 32%, which means we have less houses for sale in California today than we did a year ago from today. And look at all of these states that have negative numbers. Now, there are some that have more numbers, which is the areas growing, and a lot of people, we talked in another video about people leaving certain metros to go to these smaller metros. But if you notice, inventory is really, really low in all these places. Look at this though. This is interesting. Texas actually has more listings for sale today than they did a year ago. So that tells me that they had this influx of people that came to Texas and now they're looking to leave, or they're looking to move to a different part of the country or a different part of Texas in general. I'm not saying that they're all leaving Texas, but that is a big indicator that for most of the other states, we have negative numbers. They're positive. Look at this though. We have Missouri negative, Arkansas, we have 15%. Same thing. There's more listings now in Arkansas than there was a year ago. So just be aware of the trends, because the country, just because something's happening in your state doesn't mean that it's necessarily happening in the state that you want to move to. So understanding the metrics, understanding the migration patterns and inventory is huge. I work with real estate professionals nationwide, and if you're contemplating on a move to another area or interested in St. George, Utah, where I live, click the link below to schedule a call. Being well informed about the market dynamics and evolving trends is crucial if you're planning on a move. Many lifelong city dwellers are relocating as their cities no longer feel familiar. Gaining insights into these shifts empowers you when considering relocation. With rising stress, living costs, crime, and traffic, many are in search of a more peaceful environment. If this resonates with you, you're not alone. I provide market updates, insights on ideal and not so ideal living areas, a plethora of real estate information on this channel.
You say I have a plethora of piñatas? A what? A plethora.
I'm committed to presenting well-researched content. Do you agree or disagree with my research? Drop me a comment below. Do you think I've missed something? I try to respond to each comment. If my content resonates with you, then subscribe to my channel and like this video. I appreciate it.